Understanding financial ratios is key to making informed decisions about personal finances and investments. While many ratios are used by professionals, there are a few essential ones that everyone can grasp to assess financial health. Here are the top 10 financial ratios every layman should know to make better financial decisions. 1. Debt to income, DTI, ratio. This ratio shows how much of your income goes toward paying debt. To calculate, divide your monthly debt payments by your gross monthly income. A lower DTI ratio is better, as it means you have more disposable income after covering debts. 2. Current ratio, often used in business, this ratio measures liquidity and shows whether you have enough assets to cover short-term liabilities. It's calculated by dividing current assets by current liabilities. A ratio above 1 means you have more assets than debts. 3. Savings ratio. The savings ratio reflects how much of your income you're saving. To calculate, divide your total savings by your total income. A higher ratio means you're setting aside a greater percentage of your income for the future. 4. Loan to value, LTV, ratio. Common in real estate, this ratio compares the loan amount to the value of the property. To calculate, divide the loan amount by the appraised value of the asset. A lower LTV ratio is better, as it means less risk for both the lender and borrower. 5. Price to earnings, P/E, ratio. This investment ratio shows how much investors are willing to pay for a company's earnings. To calculate, divide the stock price by the earnings per share, EPS. A lower P/E ratio could indicate a stock is undervalued. 6. Gross profit margin. For business owners, this ratio shows how much profit you make on each sale after covering costs. To calculate, subtract the cost of goods sold, COGS, from sales, then divide by sales. A higher margin means greater profitability. 7. Return on investment, ROI. ROI measures how much profit or return you've made from an investment. To calculate, subtract the initial cost from the final value, then divide by the initial cost. A higher ROI means the investment is performing well. 8. Interest coverage ratio. This ratio shows whether you can cover your interest payments on debt. To calculate, divide your earnings before interest and taxes, EBIT, by your interest expenses. A higher ratio indicates that you can comfortably pay interest on your debt. 9. Net worth ratio. This ratio reflects your financial health by comparing your total assets to your total liabilities. To calculate, subtract liabilities from assets. A positive net worth means you own more than you owe, which is ideal. 10. Dividend yield. For investors in dividend-paying stocks, this ratio shows how much a company pays out in dividends relative to its stock price. To calculate, divide annual dividends by the stock price. A higher yield can mean more income for shareholders. These financial ratios can help anyone make better decisions about their money, whether it's evaluating personal finances, making investments, or running a business. By knowing and applying these ratios, you'll have a clearer understanding of your financial health and the potential of your investments.